Folks, unless you've been living under a rock, it's all over the place. The talk of bank failures. We saw Silicon Valley Bank fail last week, along with a couple of others. And now we've got the possibility of seeing some domino effects with other banks possibly continuing to struggle and maybe having some liquidity issues. So, what can you do to take advantage of? That's right. How can you take advantage of a crisis? Because, during great times of crisis, yes, there's a lot of people that lose money, but there's also great transfers of wealth. And even if there's a huge financial crisis, there's an opportunity for you to profit. So if you're interested in learning how to profit, I got 3 trades for you that can possibly make you a profit during a potential banking failure. Let's go. Hello, everybody. It's Jeremy Whaley here from Trade Maestro. I hope you're doing fantastic today. And I want to talk to you about 3 possible trades that you can place during a potential financial crisis, during a banking crisis in particular, okay? So before we get there, I want to pick up on a analysis that I did yesterday. So if you saw my market analysis yesterday, then you kind of have a big picture overview of where I'm at in the market and where I believe things are going. And I want to just touch on that briefly and show you what happened on Monday before we get into Tuesday's trading session. So what you're looking at here is you're looking at the Dow Jones Industrial Average. And as I zoom in, you're going to notice that this candlestick is very, very skinny. Why? Because this is essentially we closed at the same price that we opened. And so this is what we call a doji candle. And really the name is irrelevant other than that's what we call it. But that's a doji candle, and it's essentially just the same opening price and the same closing price. But the interesting part of this story, there's a couple of interesting things. In order to create this candlestick with the highs and the lows, at one point during the day, we looked like that. We were actually rather bullish for the most part. And then at one point during the day, we looked like this, and we were very bearish. But the bulls came back and the bears came back, and we ended up right in the middle, creating this doji candlestick. Okay. Now, what does a doji mean? In normal market circumstances, a doji is actually a sign of indecision. And very often the doji candle is the turning point where the next day we see some bullish, in this case, it'd be bullish behavior. If it was the other way around, it would be bearish behavior. But in this case, because it's after a swing, a lot of bearish selling. So you see that doji candle, a lot of times it's a signal that the next day is going to be bullish. And I could see that happening here. If you remember my analysis from going into Monday, I said that I could see some counteractive moves, possibly bouncing all the way up into this pivot area here around 32,750 up to maybe 33,000. I could definitely see a bullish counter move. That doesn't mean the market's bullish. And understand, a bullish move for a day or two does not mean that the market is actually in a place where you need to be buying it right now. You can have a lot of things that are causing that. It could be short covering. It could be some optimism. There's all sorts of different things that could cause it. But if you saw my analysis yesterday, then you saw I went back to 2008 and I showed you that what we saw then during that financial crisis is a 4% down, then 4 or 5% up, then 4 or 5% up, then 5-6% down, just all this volatility back and forth, back and forth. And that's what this is set up really nicely for. So it would be really natural. I'm not saying it's going to happen, but it'd be really natural for Tuesday, maybe even into Wednesday, to see a bullish counter move happening with the market here. But then I think it's inevitable, unless something really changes in the story, I think we're going to see the bearish behavior come back in. And there's a lot of reasons for that. This isn't a big picture market analysis. I'm not going to go into those details here. I just kind of wanted to touch on that and show you what happened today. Now, there's other things that happened today that are more telling than this doji candlestick. And what those are is the seizures, or not the seizures, but the halts to the trading. So there was about 30 banking stocks and financial stocks that got halted at the market open. They were selling like a frenzy. One of those, one that's definitely not getting enough talked about, and I'll probably do a separate video on this, is Schwab. Okay, so I'm trying to get this pulled up here. Schwab definitely is a trade that Well, you can see it right here. In fact, you can see that you see this green here? That was actually a bearish trade setup that we had prepared for Schwab before we knew any of this stuff was going to happen. Gapped right below our entry point there, traded right to our target. It stopped for about a half a day and then it kept going. And then it's hard to even see on here, but it's way down here. There's the candlestick from Monday. That's how far it's down. It's about 35% in just 3 trading sessions. Very, very low. Now, just so you have a little idea on Schwab, this target that we had back here was based on this support level that we had from last summer. Now, where we're at, we have to go way, way back to figure out why are we getting support here. And here's the support right here, like right around 52.50, okay? So that's why you're starting to see some buying pressure coming in here because it is a known support level. Now, will that hold as support? I think it's unlikely, but as I zoom in here and I show you right there, again, you had another one of those little doji candles on Schwab today, right around that main pivot area or that main support. What this shows is it shows you a lot of buying indecision, buying and selling. There's a lot of selling happening. There's a lot of buying happening right there. The reason I'm pulling this particular one out, this, which actually looks somewhat decent here, is after they halted trading. Okay, so what would have happened in the market today if they didn't halt trading for all those financial stocks? And the answer is, I don't know. We'll never know. It probably would have been a bigger bloodbath. Did they stop the pain? I don't think they did. I think there's a lot more selling to come. I traded through the 2008 financial crisis. This feels very, very similar to it. The news media is going to keep telling you everything's under control. The Fed, the government are going to keep telling you everything is under control. And then what happens? The dominoes just keep falling and keep falling. Okay. So there's the analysis part of this. That's what I wanted to talk about there. Now I want to talk about 3 possible trades that you can do in this market scenario. What can you do to take advantage of this? Because every time there's a crisis, every crisis also brings with it a great opportunity for a transfer of wealth. So there's 3 trades I want to draw to your attention. Number 1, let's take a look over here at the S&P 500. And this is, normally we would trade this with SPY, but if the S&P is going down, and let's say you don't want to short the market or you don't want to buy puts on the market, what can you do? Well, you can use ticker symbol SDS. And what SDS is it is an inverse fund. It's an inverse ETF or exchange traded fund. Trades just like a stock, but it trades the S&P in a short position. And this is what's going on with it. I got this thing marked up to high heavens because we've been trading it quite a bit lately. But here is my trade setup on this. I've got an entry coming in here about 46.73. We're ready to take that trade. I mean, it's pretty much ready. And if that happens, we got some really great upside targets that work on this trade. You can trade it just like a regular long stock, but because it's an inverse fund, it will go up when the market goes down. So that's one way that you could approach this particular bear market that's happening right now, is to simply buy inverse ETFs. One of those, this one here, is SDS. There's a related one, I should say, QID for the QQQ. That would be an inverse fund for the QQQ, and then DXD for the Dow. Now, one thing I want to say about this, I'll write all 3 of these up here: SDS, QID, and DXD. Okay, those are not specific trade recommendations. I'm just telling you which vehicles are inverse funds here. Okay, now I do want to say this: these are all 2x funds. Okay, these are all ultra funds, which means they're going to move a little bit faster than the index itself. That's personally what I like to trade. You can use the 1x funds, and you can just go look them up if you want to. You probably won't remember all the tickers, so you can go look them up yourself. But there's a 1x version of that if you want to. I think in a bear market, the 2x version works well. You don't want to put your entire account into it. You take a small percentage in there, and you just take a couple of trades. But for the most part, you probably want to be sitting in cash in that bear market, and then you just take a couple strategic trades. That's why I like the leveraged funds a little bit better for that. All right, that is my opinion. Obviously, you can do what you want with it, but that's part of what I'm looking at here. A second trade that you can do in this particular situation is a bearish trade with XLF. Okay, XLF is an exchange traded fund that trades the financial sector, okay? And you can see that this fund has started to tank. Dum bum bum. And without going into a whole lot of analysis on this, this fund just a couple of weeks ago, literally a week and a half ago, we were set up for a bullish trade on it. We never triggered that trade. It never happened. Instead, all this financial stuff started to break with Silicon Valley. We dropped well below, and boom, we're set up now for a bearish trade. Now, we're already well into this. We didn't take the trade as a group. I didn't do this on our Sunday night class, but this has moved from $35 an ounce down to, $31.50 or so, and continuing to fall. Look at the high volume here. So you say, well, what can I do with that if I want to make money on that? Well, the way you could do it, there's a couple of ways you could do it. The most logical way is to simply just buy a put option. So if you know anything about trading options, if you buy a put option on this, as XLF falls, your put option will go up in value. And then when you get to a target, usually one of these support levels that we've got marked in here, then you can just close that put, you just sell to close it, and you take your profit. So that's really probably the fastest and easiest way to make bear market profits off of this financial sector as it continues to fall here. There's some other ideas that you could do with it, but like I'd say, the most straightforward one is to just buy some put options. Generally speaking, I recommend you buy at the money options. I'm not a person who recommends buying out of the money options. I can certainly go into that and tell you why. But, if you just want the fastest path to success here, buy at the money or slightly in the money put options. That's usually going to work better for you. I like to say at least a delta of 50 or better. Okay, so you're getting into the money on that, and that's going to see a profit a lot faster for you when it's moving. Second thing, and really the more important one, well, the strike price is important. I would say at or in the money. And then the second thing to look at when you're buying and selecting your option is make sure you have plenty of time. And I recommend 4 weeks more time than you plan to be in the trade. So I'm going to suggest probably this financial collapse, crisis, whatever we're about to experience here, it's probably going to fold out over the next 2 to 3 weeks, which means in the next, couple weeks, this will be done. Whatever the fallout is, it will happen. The same way it played out in 2008. Whenever that happened, it took about 2, 3, 4 weeks for the bulk of that crash to happen. And then, you had several weeks after that, it's a couple months after that, where everything was kind of stabilizing. So you're going to see the same thing happen here. So I would say right now it's the middle of March. Be looking at April and even maybe into May options at the money right now. And that's a good way to approach it. Now, I would not, notice what I'm not talking about, I would not go to the individual banking stocks. I would do this with an ETF because there's a little bit more stability there. The ETF's not going to disappear. The banking stocks will halt. They'll stop trading. And so the ETF, what will happen is you can still maybe get into and out of that fund as you need to, even though the individual stocks within it maybe stop trading. So that's the way that I would approach that. So that's another idea for you to do. Now, the third idea, so idea number one that I gave you was to trade the inverse funds, okay? And we specifically talked about SDS. The second idea is to just buy straight long puts on XLF. That's ticker symbol XLF. That's the financial exchange traded fund. And then the third idea is to go to the hedge or the offset, which in this case is probably going to be gold and silver. Why? Because whenever people are worried about the currency, where's the natural place to go? Well, usually they go to bonds, but bonds are actually part of the problem right now. So what we're seeing is a huge flood into gold and silver. So let's go take a look at that. The two ETFs for this are GLD and SLV. We've had this GLD trade set up for a few weeks now, actually a couple weeks. And our next targets on this are up here around 186.30. But GLD, this trades gold. And as the dollar does goofy things, as banks do goofy things, and bonds do goofy things, GLD will typically go up in value. So we're already in this trade as a group. We did this Sunday night. So I'm not going to go through the whole trade setup with you here, but that is one. Our next target in this, as I said, is 186.30. And then there's other highs beyond that we could look at. $200 is going to be a big fat round number. 194 is a resistance area. So we'll have to see how that plays out for now, but that's the picture of gold. And then SLV, this is the silver ETF. And this one, it took a little bit longer to get going. We've got a trade set up at $20.67 for an entry on this trade. So we probably can go ahead and get into it. We had given quite a bit of cushion waiting for the trends to reverse, but now all this banking stuff has happened, and so it's looking a little bit better. Next major target on that is going to be up here in the $24 range, and I'm not going to go into why we've got those targets, but if you can, just trust me, we have a reason for them. So right up around $24 will be our next target for SLV. But there's 3 trades that anybody can do really quite simply. You don't have to be an advanced options trader. You don't have to be advanced to anything. You don't even have to trade short options or short stock. You can short the market via a long position in SDS. You just buy SDS, and that is holding a short position in the SPY, basically. Okay, so that's trade number 1. Trade number 2 idea is to actually take a long option. So again, no shorting here, just buying a long put option on XLF. That's the financial ETF. And then the third idea was to buy GLD or SLV, which is gold or silver in the form of an ETF. Okay, so there's just a few ideas that you can look at doing in the middle of a financial crisis and maybe making some money in the midst of chaos. All right, if you like this, you want to learn some more, be sure to like and subscribe wherever you are watching, and be sure to check us out over at trademaestro.com, get subscribed, and register for our email list over there. Okay, thanks for watching. I'll have some more stuff for you coming up soon, and until then, I wish you all the best. Happy trading. We'll talk to you soon.